All right. Welcome, guys. We want to start doing these weekly or every other week. These are going to be called implementation sessions because we're just going to help you implement and execute things that we teach, things that we've learned that we want to share with you guys, and ways to continue to make money in Web3. If you figured it out by now, there's tons of ways to make money in Web3. And if you just look at the numbers and you look at the volume of what's happening, there's billions and billions and billions being pumped in and being made every single day. And most just don't know how or don't know what strategies or tactics to use. There's a couple that we like best. About a week and a half ago, Brandon and myself and a couple other 7 and 8 figure traders got on and share with you what's called the mailbox money method. And that method is making money without the volatility of the market, whether the market's up or down, staying consistent. And we also had Mario, who got up to, I think, 56 million in his portfolio from 80 to $100. He talked about trading volume and some KPIs he looks at and how to trade his way. So we're just going to come on and execute and help you guys implement. We're doing these calls for you, and whatever we feel like you feel like is the lowest hanging fruit, whatever needs immediate attention, we can help you with that, answer those questions, talk about ideas, market updates, and do some Q&A, and that's it. So no strict agenda. We're just here to add value to you guys because we want all of you to be well positioned as best of your ability when this next run happens. And I think it's going to get exciting over these next couple of months. If you remember the chart Simran pulled up and you remember some of the charts from the previous calls, October, November is very, very green 6 of the last 7 years. Even in the bear market, it was still green. And in the bull market, October, November, December gets exciting. And I see that happening at a very high level this year. And most people got scared out the last 6 months because of the volatility, because of the so-called events that happen that causes big dips. And a lot of people have found out they're not really built for Web3 yet till they can stomach some of these ups and downs, right? But if you can have strategy to combat that, that's the game changer. So we are looking for ways to help you offset the volatility and unexpected stuff that happens. If you can't control the market, you got to control how you play the market in a sense, right? There's a lot of things coming up. I don't know if you guys have noticed, but Trump is coming out with a coin very soon. And I don't know if you saw, Brandon, but Evan's been talking about that for months. And I was like, are you sure? And there was a lot of intel in some of the groups I'm a part of that knew about it, that are on, I don't want to say they're on their inside, but I guess they are. And I was like, that'd be crazy because that'd bring a lot of liquidity into the market and it would bring a lot of hysteria. So it is happening because it's been tweeted and talked about many times from his account, his son's account. That would be interesting. And my intel says it's going to launch. Can we share what we feel, what we heard it's going to launch at, Nick? Is that possible, or should we just let that topic go until we find out more information?
Uh, I think it's safe. I mean, it's circulating in some Telegram groups, and I talked to, for better or worse, don't know where anybody stands politically, but I talked to the Trump family office. I actually talked to them this morning, and it seems like they're pretty set in stone with their plans.
And it's going to launch. I think it's going to launch at like over $1 billion market cap, because of the volume that it's already done behind the scenes. And I think, no, it's going to launch at a couple billion market cap possibly. And we're trying to figure out ways to see if we can get in a little earlier than that. So nothing's been set in stone, guys, but we'll keep you posted. But that's the stuff that we want to bring you, is just stuff that we learned from networking our butts off the last 15 years, being in the right circles, and then giving it to you guys so you have an edge. That's our goal. So do you know what it's launching at? I've heard 5 billion. I've heard very small amount of private investors can get in at 1 billion, but I'm not sure certain on any of that. I know you know some stuff.
It depends on how they roll it out. So it's supposed to launch at 10 cents. And there's 100 billion in max supply, but that entire supply is not circulating. So it depends on if you want to count circulating supply as the market cap or the max supply is the market cap. So for those of you that don't know, you can figure it out by saying, okay, 100 billion at 10 cents. So if you do 100 billion times 0.1, you'll get the market cap. And again, I know it's overly simplistic, but if you ever want to figure out price, supply, market cap, if you have two of those things, you can figure out the other one.
Yep.
The market cap is simply the supply multiplied by the current price.
That's good to know because a lot of people don't know that. So that's a positive thing. And we have to be ready for whatever. You have to be positioned and make sure that you're ready to take advantage of whatever happens, good and bad. I think that's important to play chess here and not just go with the flow and hope things do well. Hope is not a strategy. So it's important, if you've never been through a full cycle, guys, to make sure that you understand the importance of keeping an even keel in a sense, right? I have tips that I've shared with you guys before, but the crypto space evolves so rapidly. There's technologies, there's new platforms, there's regulations emerging like nonstop. And the people that are in the top 5%, they're just always learning. They're continuously learning. Risk management's important. Technical analysis is important. Emotional discipline is important. Not having FOMO, ability to control your emotions, the ability to avoid fear of missing out. There's a lot of things that you have to understand, because it's so easy to look at a Twitter post or look at a YouTube video, and an influencer says, I made $100 million last week. You know what I mean? I made 5 million from 9 cents. And you see that crap everywhere. So it makes people think they're missing out. And the problem is, a lot of people aren't understanding how to take profits or how to leverage certain things that they know. And instead of, when they have a 4 or 5x, they're like, I got to get 100x. So it's understanding what's happened to you and your portfolio the last 6 to 8 months, learning from it, and having a fresh slate and a fresh perspective for the next 6 to 8 months. A lot of you guys know some of my favorite plays that I feel like are going to do really, really well. And a lot of you guys know some of my tactics, but that's why I want to bring some new experts and some other people in here for a fresh perspective, right? So today's about figuring out what you need help with in terms of immediate action, okay? Brandon's made a lot of money in crypto, and what I like about Brandon making a lot of money in crypto is it's not based off if the market's crushing it or if it's down. He makes consistent income that's steady, whether there's volatility or not. Some people pay him, just so you guys know, $10,000 plus to teach some of this same stuff. Now, you don't have to pay 10K plus right now, but just know that it's very in demand, and he doesn't teach it to a lot of people, but because I've convinced him and he loves helping people, he's going to share some of that stuff today, and we'll just do some Q&A. Nick's one of the most brilliant people I know in Web3. So you guys have a lot at your disposal, right? And you got to be hungry to learn and to grow and to be able to capitalize on this crazy market that we're in. And a lot of people are calling this the digital gold rush. And people are like, digital gold rush? I haven't made money. Well, that's a personal problem, right? And we want to help you with that. So that's what today is about. So Brandon, I'm excited to have you. Nick, thanks for being on. I know you're busy as well. And also we have some stuff that we've been trying to plan, guys. Crypto events and all kinds of stuff. We have the event with John Maxwell and Michael Francis coming up in Las Vegas. You can go to innercirclelive.com to get into that, but that's going to be October 5th. And we're looking to do a crypto event sometime in November. No exact dates yet, but there's some exciting stuff going on behind the scenes. Just know myself, all of my team, a lot of my inner circle, a lot of this team is working around the clock to make sure we create the best possible value for you guys consistently. So know that. But yeah, Brandon, you can let's start with, I know you've gotten some questions in the past, and
Yeah.
I know you've gotten people that are like, I want to execute this mailbox money strategy. And I want to be able to make money from it. Some people don't know about it. So why don't you start with what you feel like is best in terms of explaining the mailbox money strategy and kind of how you've executed that? Because there's a lot of things you talk about: principles, strategies, tactics, and tools. But today we kind of want it to be a little more about like the tactical side, not the principles and the strategies as much, but the tactics on how to do it. So yeah, I'll let you take it away, and then we'll do Q&A.
Yeah. Yeah. And on that note, everyone who's in attendance here live, just know that at any time, if you've got a specific question or if you've got something very specific that you actually want like help with, how do I buy X token? How do I create this pair? How do I compound? Whatever it might be, drop that in the Q&A. The purpose of this session, implementation session, is to help you with those like in the trenches considerations, because yes, there's lots of opportunity here. Yes, we're teaching principles and strategies, but at some point you got to get down to which buttons do I click? How do I actually like make this happen to put my money where I want it to go so that those assets, those crypto assets, start to go to work for me? Now, Mailbox money, in case you missed it the first time, is basically just saying, hey, you have some crypto assets. You have Bitcoin, you have ETH, you have Guard, whatever it is. One option is to just hold those assets and wait for them to appreciate in value, at which point you would sell them at, ideally, a profit. Mailbox money is saying, hey, you can take those assets and rather just having them sit there, you make them into productive assets rather than non-productive assets, meaning they can actually produce something else for you while you are holding them. And if you pause and take a step back and think about that, that changes the game completely. My favorite metaphor to explain this is real estate, because that's something tangible that most people understand. I could buy a house for $1 million. I hold on to it for 10 years. I sell it for 2 million. Great. I made money on that transaction. It's not bad. It's just that that was one layer of profit opportunity. Now, if I bought the property and then also rented the property out, I have 10 years of rental fee income and I have the profit that I make from the appreciation of the base asset. Same thing can happen in crypto where you have your base assets, and rather than just holding them and selling them off in a few years or a few months, whatever your time horizon may be, you put those to work and they produce for you not a rental fee income, they produce for you trading fee income. And what that means in a nutshell is if you become a liquidity provider, then you get a portion of the trading fees that are generated from those liquidity pools that you are participating in. Now, what I love about the approach is because the first question I'll always get is, well, where does this yield come from, Brandon? Where is this magic money being generated out of nowhere? It is magic, but it's not being generated out of nowhere. It is being generated because people are paying to have a service rendered to them. Okay. So they want to make a swap. They pay a transaction fee to make that swap, and they're getting that's a service that's being rendered to them. Now, on the other side of the equation, the decentralized exchange platform, the DEX, you're rendering them a service. You're saying, hey, you have an exchange platform. The only way that exchange platform becomes faster, safer, more reliable to the end user, which they want to attract more end users because they make their money on trading fees too. The only way to attract more people is to make that platform safer, faster, more reliable. Therefore, we want to attract liquidity providers because deeper liquidity and more liquidity makes the trading platform itself more reliable over time. So you are rendering a service to the decentralized exchange platform, the DEX, and that DEX is rendering a service to the trader or the trading bot or the investor, whoever it might be. So there's actual real value being exchanged. And for me, anyway, when I finally understood that, that was the light bulb moment where I go, oh, I get it. You can play the day trader game. There's nothing wrong with that. I mean, you guys heard from Mario. He's wildly successful at that. So that's one way to do it. All I'm saying is here's a different way. And depending on your personality profile, depending on your risk tolerance, and ultimately depending on your time horizon and big picture financial goals, one strategy over the other might be your preference. So I'm not here to tell you this one should definitely be your preference. I'm just here to give you an option and say, hey, if you want to play the mailbox money game, you become a liquidity provider. By doing so, you generate trading fee income. Now you have real cash flow, and you can take that cash flow and do with it what you will. You can compound it back into more liquidity pairs. You can take it and play, moonshots and meme coins, or you can just accumulate macro belief. Okay. So, we're not shy. We love Guard over here. Some of us love Bitcoin. That's great. You could say, hey, I'm going to become a liquidity provider. And with all of the cash flow income that I'm creating from that, I'm just going to buy Bitcoin and guard, and I'm going to accumulate that for the next 5, 10, 20 years, whatever it might be, in anticipation of having that massive nest egg that I am financially free from. So the idea here is that there are multiple pathways, and I'm going to diagram out for you here today just one pathway. Okay, obviously there could be many, but I'm going to diagram out one just so you have like a clear picture of what this could look like. And what I'm going to share with you today is one pathway that I am actively participating in. Okay, so you can know ahead of time, like I'm biased towards this methodology because I'm using it and it's working. And then it's up to you. If you want to follow along and do that pathway as well, that's great. If you have a different pathway in mind, that can work as well. And while we go, drop the questions in the Q&A. I saw we had a couple. We'll get to those here in just a second. I'm going to do the quick diagram out first. And if thoughts pop up, you need help with something tactical, drop it in the Q&A, let me know, and we will get to those.
Yeah, there's some great questions already. So good questions, guys.
Okay, cool. Can I share screen? Peter, can you give me permission to share screen?
There you go.
Yeah. Okay. Hold on. Let me look at these questions because this might shape the demo that I do here. I'm sure you'll get to these questions from last call. How are you deciding which pairs to choose? Okay, so asset selection, like guard, because I believe that will continue to rise. But how do you decide which pair to go with? Okay, so I'm going to write this one down. So we've got asset selection, and that is extremely critical. We could do 3 hours just on that. Is it smart to just do a pair with, say, ETH or SOL, as those are more stable coins and will do well over the years, or go more on stable coins and get better returns? That's also asset selection and also a fantastic question. Briefly, what personality type is best for each strategy, or how can we find out what's best for us individually? Yes. Okay. Let's start there, because that, move this window around here. So let's start with personality profile. Hey, what fits better for me? And here's what I would say. It's going to depend on, number one, risk tolerance. Number two, time horizon. And number three, big picture financial goals. Okay. So the idea here is, well, this is the principle of, and you'll hear this, we'll go over this many times, closer versus more. It's a very simple concept. It's saying if the strategies that I'm using and the actions that I'm taking get me closer on a regular, consistent basis, closer to what I want with a risk mitigated overall approach, I'm good. So I don't necessarily need to chase more all the time, because that often gets you wrecked, right? This is what Peter was just mentioning. You jump into a moonshot, you get 5x on your money. Like, by any other standards, that would be insanely good. And we should be celebrating, go like, oh my God, I put in 1,000, I got 5,000 back. Like, this is insane. Let me take that profit and be happy with that. Instead, we go, no, I'm going to wait for 50x. And then what happens, well, especially in the meme coin space, boom, it tanks and you end up with like maybe getting your money back and maybe at a slight loss, instead of capturing that 5x when you had it. So that's the principle at play here, is closer versus more. So which strategy could be better for you? If you have a high tolerance for risk, if you're confident that you can trade with like a strategy that Mario laid out, where it's like, hey, we're going to take a look at some technical analysis, some trade volume, and you can follow along with that, and you're okay with the emotional volatility. And that's what people don't always acknowledge up front, is that this game is primarily a game of managing emotional regulation. And if you know, oh, that emotional volatility, that's fun for me, like it's exhilarating, then probably, yeah, like a day trader moonshot kind of an approach could be great for you. On the flip side, and that would also be a very short time horizon, and your financial goals would be like, high return in a very short period of time. So then that's when that approach would work best. A mailbox money approach would say, hey, I've actually got a lower risk tolerance. I prefer to be in like the tried and true reliable crypto projects. I love Bitcoin. I love ETH. I love Arbitrum. I love Guard. I love whatever these, I love Chainlink, like the ones that have been around for a while and are steady and consistent. And you want to be invested primarily in those with your base capital. So you have a lower-ish risk tolerance. Then a mailbox money approach might be the better approach for you because we're saying, hey, I've got, a lower risk tolerance. I'm going to get into blue chip crypto assets, and I've got a very long time horizon. I'm okay being in the market for the next 4, 8, 12 years, whatever the time horizon is. And I just want to steadily collect trading fee income along the way. Because here's the reality, when it comes to fee income, and remember, that's the cash flow you're producing by becoming a liquidity provider, you can actually get, and these are real numbers, based on not only my personal experience, but based on the hundreds of investors that I've worked with in the mastermind, you can get on average a 50 to 100% APR. That is just trading fee income. That does not include appreciation of the base assets. So meaning, even if you go the low end and say, even if all I ever got was 50% a year, like that's, again, insanely good compared to any other traditional asset classes. Now, you'll probably do better than that over the course of the long term. I'm just acknowledging, hey, worst case scenario, you're still doing very, very well. And then you say, okay, and then what are my financial goals? Let's say I have 20,000 to start with and put into the market, and I know in 14 years, I would like to get to 1 million or whatever your numbers are. Okay, I'm just kind of making up an illustration here. Then you can reverse engineer the math and know I have to get X% return per year on average, accounting for compounding, in order to hit my goal. Then you say, okay, if I only need 57% a year or whatever your number is, you might consider a strategy where lower risk, you've hedged your bets a little bit, and you're investing in the projects that are tried and true. Okay, that's one way. That's one way to do it. So the short answer to the question is personality profile and these three considerations, acknowledging that emotional volatility is actually the real game here. Because I've seen people make wacky decisions that they otherwise would not have made because they weren't able to just manage and regulate their emotions. Okay. So, all right, great question. I spent a little bit long on that one. Let's go back to Bobby. Bobby was talking about which pairs to choose. So this is asset selection. And then Bobby had another one. The smaller range gives higher returns potentially. Yes, tighter concentration, tighter range and concentrated liquidity, V3, yes, tends to be higher APR. A wider range is lower returns. Can you just do a smaller range, but then just redo the pool when the range changes, but then you are subject to the fees to set up the pool? All of that is correct. So you can set a tighter range in anticipation of higher APR, acknowledging that if you want to stay in range, you will probably have to rebalance that range on a more frequent basis. And yes, there are some costs associated with rebalancing. So if you pull the range too tight, you might be rebalancing twice a day, in which case you are likely to eat up most of, if not all of your gains from the fee income. You could potentially eat up a good chunk of those just rebalancing constantly. So that's the game. Is super tight range would be, again, personality profiles, higher risk tolerance, because you're going after a higher APR. Whereas if you're a value investor with a long time horizon, you can say, I'm cool with taking a really wide range, even maybe like an infinite range, like a V2 infinite range. And I'm cool with just getting a lower APR because I know I never have to rebalance then.
Yeah. Brandon, can I jump in real quick? Just
For
a
sure. Yeah.
little distinction. So I live in infinite range, like V2 liquidity. Not because it's optimal, but because there's a distinction to make when, in my opinion, and I know Brandon, you echo this as well, is if you go into crypto thinking it's going to be like a passive income and it turns into an active income and you're unaware of it, you won't get the result that you expect because there's a disconnect.
Mm.
So I think one of the things to determine is, do you want this to be a incredible passive income source or an active income source or something in the middle, but you have to be aware of it. Otherwise, your plan on paper will have it listed as like a passive income source, and it'll slowly seek into becoming active, trying to get a greater return. And you just have to account for that. You have to be aware of, you know, is this a passive thing? Is it an active thing? Et cetera, et cetera. Just so you can make decisions on how to spend your time.
Yeah. And that's absolutely critical. We could say broad strokes, passive, like if you want a truly, truly passive investment vehicle, that would be a V2 liquidity. So just as an example, you might say, hey, I want to be in guard USDT. I'm going to choose V2 because I want this to be passive. Or you can use V3 and you just select infinite range. Same idea. And then you can just hold this pair and ride it for as long as you want. So if you're truly like a long-term value investor mindset, you would say, hey, here's my pair. Got it. I'm just going to put my money in there and maybe add to it over time. And I just let it ride. And then over the course of 10, 12, 20 years, that's a lot of trading fee income that will add up and compound over time. Okay. All right. Let's talk about asset selection, which pairs to choose. Now, again, we could do probably 3 or 4 hours, if not more, just on this because there's a lot of variables at play. Let me offer kind of some broad strokes considerations that would shape which assets that you even start looking at in the first place. So categorically, number one, I would say network tokens. For example, ETH is the gas token of the Ethereum network. It's the utility token. You need that token to do anything on that network. It also happens to be the utility token for the Arbitrum network, Arbitrum being a layer 2 built on top of Ethereum. Sol is the main utility token, the gas token for the Solana network. BNB would be that token for the BNB smart chain, the Binance smart chain. So those assets tend to work really well in a pair because they're highly traded. The trade volume ultimately is what drives the APR. I mean, it's a ratio between trade volume and total value locked, but the trade volume plays a significant role in driving APR. So for example, we could say I want to do a network plus a stable coin. All right. That would be, and again, this is just one example. I could do ETH USDC. So I've got the network token. I've got why is there so much volume around this? Primarily because there's a lot of traders out there who want to try to make gains just from ETH or just from Bitcoin or just from these network tokens. So they're constantly switching in and out of stablecoins. So those that like categorically network token plus a stablecoin, those tend to be, again, broadly speaking, really, really good pairs. Okay. Then you got, by extension, just pairing two network coins together. Now, you can't do this with every one, but for example, you can pair ETH and BNB. You can do it on both the Ethereum network and the BNB smart chain. And anyone swapping back and forth between those two network tokens, again, it's a very popular pair. You tend to do very, very well. Okay. Then I would say, um, let's do, let me think here. Let's go based on trade volume, and I'll show you how to look this up. So trade volume would be if I want to search for an asset based on its total trade volume. Okay. So I could pull up Crystal, my handy little Crystal app here, and I could say, hey, I want to search on the Arbitrum network. Right here, I can select my network. I want to search on the Arbitrum network, and I'm just going to click on 24-hour trade volume. All I'm looking at now is which pairs have the highest trade volume. So this is 24-hour volume, 70 million, 51 million, 34 million, 23 million. Now, it doesn't automatically mean it's going to be a good pair to provide liquidity for. It's just that the variable of trade volume tends to predict with relative certainty how much in trading fees are going to be generated from that pair. So it helps you kind of narrow things down. And then I would say treasury assets slash deep liquidity paired with a network or a stable coin. Okay. And the easiest example of this is Guard plus USDT or BUSD, either one. And when I say treasury assets and deep liquidity, I mean, if you take a look at, for any asset, not just Guard, if you take a look at the ratio between the liquidity and the market cap, for most crypto projects, it's really skewed. You'll see these projects that are like, $1 billion market cap, but there's only 5 million in liquidity. Doesn't mean it's bad. It just means highly volatile and likely to have huge price fluctuations. Versus when you have the project with deep liquidity, the project itself has more stability. And so you can say, all right, I'm going to pair something extremely stable with another stable coin. That would be your more risk mitigated long-term approach. All right, let's continue on because I want to try to get to as many of these as I can. Will you speak to how to set the spread on the lows and highs when setting the liquidity pair? Yes. So broadly speaking, and again, there's nuances. It depends on which pair and how you're going to set that liquidity. So remember, we talked about tight range is shorter time frame, higher risk, whereas wider range would be longer time horizon, lower risk. So how to set the lows and highs, again, partially depends on you and your personality profile and your risk tolerance. If I want to play the tight range game, usually 10% on each side is like a very tight range, and that will get you a really nice APR. And I would say a wider range would be like 30% plus, again, on either side of the current market rate. But this can extend all the way to, you might want to go like an infinite range, or you might want to set the concentrated liquidity range in anticipation of the upside. So you might set it for like -5% on the low side and positive 2000% to the upside, meaning if you believe in the project and who's involved and where it's going long term, you would want to give yourself a massive cushion to the upside so that you can just keep collecting fees on your way up and you don't have to adjust your concentrated liquidity range or do a rebalance in order to accommodate that. Again, it's just more of the not completely passive, but very close to passive kind of approach. I noticed that trading volume on Guard is very low. We are just speculating this volume will increase. So, Andrew, that's a great question. And Nick, you can jump in here if you want to. What I'll say is yes, anticipating higher trade volume, That is partially because of all of the projects that are being built on Guard in the background that will long term produce not only massive trading volume, but consistent trading volume. And so this kind of goes back to what Peter was talking about. Are you on the inside? Do you have the information ahead of time? And do you know that this is an opportunity to get in while things are still quiet before the frenzy occurs? And again, it's a different approach because you could just say, hey, I'm going to pair Bitcoin and ETH. Those have already proven themselves. Or you could say, hey, I have an opportunity here to get in early on something that, because of what's happening in the background long term, will eventually produce massive amounts of trading volume.
Yeah, and there's I'll speak to that as quickly as possible so we don't take up too much time. And I think there's people here. I look at the participants that experience this is when after Anchor and FTX and the whole market shenanigans, there were days people were losing their minds because the market would kind of slow down a little bit, and there were days where Guard had 100 million plus in trading volume over 24 hours. Like we had 3 or 4 days over a 1 week period. And so there, it is helpful sometimes to look at the history of what's happened in the past, have a little foresight about the future. To just to Brandon's point, and I don't just high level, don't want to influence anybody to do anything they don't understand, but uh, there's a little bit of to Peter's point, and just to echo what Brandon said, there's a little bit of skate to where the puck is going, and a common sentiment amongst crypto people is, man, I wish I was early, but their behavior is not aligned with that, where they're saying, hey, look, everybody's doing this, so I'm going to do it. So by definition, you're not early. So there's a little bit of dissonance there. And it's okay if the strategy, specifically liquidity, uh, you may do a pair that is more proven over time consistently, and that's going to be the more mature pairs. Guard is relatively young relative to Bitcoin, ETH, Polygon, etc. Matic would be the Polygon token. And choose to acquire maybe a speculative asset. Like you could use yield if you wanted to use yield on another pair, use the generate yield with another pair, use that yield to create a Guard pair, right? And so you can kind of mix and match these things based on where you're at. But just generally speaking, the big dissonance is I want to wait till everybody else is doing it, and I also want to be early. And you got to pick one.
Yeah.
So hopefully that makes sense. That's a great question. And you can look at, if you look at the Guard BUSD pair on Night Swap, and you go back probably a year and a half, you'll see 50 million, 70 million, $100 million days.
So, Nick, my thought would be, if there's a lot being built right now, especially with Avanti 3 and with the tours coming up, and with what a lot of the people Web 2 that are very famous in their industry are doing, that I can't share exact names yet. Would it be wise to try to get this down and master it before the crazy volume comes? In my head, that makes the most sense.
Yeah,
versus doing it when there's a bunch of volume. I guess
I want to give I'll give a couple examples that remember, crypto works at lightning speed relative to everything else. But let's use the dot-com bubble as an example. So at the peak of the dot-com bubble, early 2000, Amazon was $4. It's $180 today, right around. So there's a lot of people that rushed in at $4. It crashed. They panicked. They left. Amazon did what it did, and then it became one of the most valuable companies on the planet.
Yeah.
The mistake is those same people waited until it was popular again to get back in. So there were years of it looking almost like it was dead that you could have been studying, researching, understanding. But if your personality is, I'm just going to wait till it's exciting, you're already late. So I would absolutely take this time. If there's an asset you're particularly interested in, I would be the most interested in it when nobody else is.
That's so hard to do for people.
Yeah.
And that's the trait that people that get filthy rich and go 1000x, that's the trait that they share. is they understood what they were doing uh before all the hype. Because if you try to study something when there's a ton of excitement, your brain will not be able to like process it deeply because you're gonna get caught up in all the euphoria and then the fear and then the greed and then the
That's so
so
true.
this yeah,
So
this
it's
would be the
almost
time.
going against it's almost going against human nature, because human nature, people are like, what I see ruin most people's bag and kill their income in crypto is just FOMO. It's the opposite of being early. The opposite. So why can't people be early? Why is it so hard for people to understand? Like, I can see it with Bitcoin early. I got in Ethereum early. I got into a lot of projects early, like because I saw it. I got into now I didn't get into Guard crazy early because you guys almost hit a billion, but now I'm seeing clearly where it's going. Why can't most people see that? What is wrong with the human mind in a sense that it's hard for people to get into places early because they wait for other people to get in first? It's like third person validation.
Yeah, there. So if anybody wants to, you can study this. It's called diffusion of innovation. It's very dense, but the short answer is, most people look for what is called safety credibility. They look around, and if everybody else is doing it, it feels safe, and that is counterintuitively. That's where the real estate bubble, the dot-com bubble, that's why bubbles burst and people lose, is because they're looking around waiting for everybody else to be doing it. It works for things like automobiles, like a Tesla. Not investing in Tesla, but you may not want to drive a Tesla until you see it around the road, right? So it works in most of our life. That is an appropriate time to adopt something, is after you see everybody else doing it. But in finance, in investments, it's not.
Yeah.
So we're very wired for safety credibility. And the way to be early, and again, you can study this in Diffusion of Innovation, which was published the first time in like 1962. It's not new. Uh, Early people seek what is considered competence credibility. They're either competent themselves, so they can read a white paper and they understand what it means. They don't need to see everybody else doing it to comprehend what it would mean for them, or they're betting on the competence of the people involved. So maybe you invest in Tesla because you just like, shit, Elon knows what he's doing, right? So these are the people that would bet on, just to give you an example, Dr. House. You know, if you've seen Dr. House, he's like off-putting and nobody wants to deal with him. And the people betting on competence credibility are going to bet on Dr. House because he's better. People that bet on safety credibility are going to bet on the person that everybody likes and is super nice, even if they're a worse doctor. So I think that's the big reason, is we're just wired. Most of the population is wired to look around and make sure other people are doing it. Like, you want to see somebody else bungee jump before you do it. But it doesn't work as well in open market for investing. So it's that wiring to seek safety credibility or safety.
It's almost counterintuitive because in real estate, that's how the bubbles happen. So you get in because everyone and their mom's doing Airbnb, and then you see the rates in the market drop, in terms of, then it's harder to make money because everyone's in it. It also happened with crypto back in 2020, 2021, because there was so much euphoria. They say once you see celebrities coming out with coins and your grandma asks about Bitcoin, that's when everyone gets in, but that's usually when things are going to start
Yep.
dipping. So it's almost counterproductive. So not only does it not work, it's fear based. You can't even actually make money doing that in the long term. So
Yeah. So think about, I'll share this because we got a group of people here that are talking about farming and providing liquidity and guard. You might be like, well, nobody else talking about that. And that's, in my opinion, that's a good thing. So if we go to a domain that everybody will be aware of, let's say you know real estate really, really well. You've done really well in real estate. And what have you done? You've bought when it's cheap, you've sold when it's high, all that stuff. So if somebody comes in and says, I'm a real estate expert, and they didn't say anything until everybody's making money in real estate, what would you think about that person if you truly understood real estate? You would say this is the most dangerous time to introduce people to real estate, when it's exciting. So generally speaking, anybody that says, people will say, I told you so, that's fine. But if you're learning from people that are just hopping on whatever's popular right now, that's the equivalent of learning real estate from somebody that just started talking about real estate at the peak of the market, the most dangerous time to enter. And so that's the whole, it's at the most dangerous time to enter is when everybody jumps on board. And because they jumped on board, everybody watching them jumped on board. And that's kind of the cycle. And we don't realize it. So we're always wondering, like, how do I keep getting dumped on? Why do I keep buying the top?
Yep.
How does everybody else keep winning? And I keep losing. And so it's just recognizing that the time to get the maximum benefit, the time to get in would be when there's the minimal amount of conversation about it. And the people that were talking about Bitcoin when it was all, so, Bitcoin went down to whatever, 20 grand recently, and everybody stopped talking about it. The few that kept talking about it, those are the ones that I would pay attention to. And that's kind of, again, counterintuitive. So you really got to work hard to overcome this kind of this human impulsive mindset to do what everybody else is doing. And if you want to seek safety credibility, that's fine. Some people are just wired that way. And if you are truly wired that way, which if you're on this call, you're probably not, like your grandma probably is. Don't look at crypto. Like, you don't get the 1,000x returns by seeking safety credibility or safety indicators, because the safety indicators don't exist. Like, what would they be in crypto?
For sure.
You know?
I mean, really, if we want to get technical, it's kind of like being early. It's access, it's knowing people, it's intel in a sense. We can't talk too much about that, but that's it right there. People have that. We're trying to give people that in a legit, ethical way. And you say it's counterproductive or counterintuitive. I think getting wealthy is counterintuitive, which is why if you look at the wealth gap, it's 5% making all of the money and then 95% struggling. And it shows you why, in a sense, because there's more of a risk tolerance, or they are very, very good at understanding, like you said, white paper and specific business models and where the economy's going, AI, blockchain. They get in early. And the people that got in early on the dot-com bubble, Nick, a lot of them also are early with this. They're just early on almost everything, which is why, look, how did Mark Cuban make his beginning money? Like, he got early I can't remember exactly how, but he was early.
Yeah.
So it's very important. That's
And
great.
just understand that uh being early is very difficult. It's very difficult because it's more volatile. There's more vicissitudes when you're early. So a number of people that say, God, I wish I bought Bitcoin at $1. It's like, why? You would have sold it, then it went to 3 and then went back down to 1, and you would have panic sold it. So you can't just you can't just be a different person than you are. So if you really do believe, hey, I want to be early, I want to be positioned well, then you have to you have to understand all the stuff that comes with it. You're going to handle a little more of the vicissitudes. You're going to, some things are going to pop off, like you buy ETH and then Bitcoin goes up. You're like, damn it, wrong thing. So you flip over to Bitcoin and then ETH goes off. Like, you have to have the ability to have a belief in what you're doing and let time play out. And what Brandon is teaching, and why I think this is important, because there was a question about a permanent loss, which I'll let him explain. Uh, the important thing is to just realize we don't have a crystal ball. It's so we got to stop pretending like we do. We look back all the time and say, man, I wish I would have done that thing instead of this thing. It's like, well, you didn't have a crystal ball. And
Still,
what you can do is what Brandon is teaching here is, whether it goes up or down, as time passes and you wait for things to play out, you're getting paid, right? You're getting yield, and you can use that yield to do whatever the hell you want. But maybe there's an asset that is too early for you to really feel good about it. You can acquire it with your yield. It's free money. Or you can just mailbox money. You just take your money and buy shit. So that's the beauty of it, is you can get the benefits of being early and get paid for waiting.
I recommend, by the way, watching the previous call too, guys. Watch the previous call that we all did, because you actually shared that exact yield and what to buy and how to put it back in, and your strategy in it too. So yeah, thank you for sharing that. And Bobby asked too, getting into a pair that isn't as popular like Guard yet versus an ETH pair, does that mean you could potentially get higher returns later?
Yeah, I mean, you could potentially get higher returns, you could potentially get lower returns, but you see how that's, in my opinion anyway, and Brandon's done a lot of work on this. So I'll defer to him. But the the point here is even Bitcoin. I believe even if you got Bitcoin at $10,000 at that time, it was risks and probabilities. There are no certainties. And so it's really understanding, in my opinion anyway, okay, and trade-offs too, right? So you got $100,000 to deploy. You can get 1% in your bank account. You can get 7% in the S&P over time or whatever you get in the S&P. You can maybe get 1,000% in crypto, but holy shit, are you gambling all your money away? Whereas what my favorite method, which is what Brandon is teaching, is a middle ground where it's a hell of a lot better than traditional finance. It may not be the 1,000x, but we don't have a crystal ball, so you're more likely to lose all your money than get the 1,000x. Uh, but shit, we could engineer 30, 40, 50, 60% a year. And just knowing that changes everything for you potentially. And while you're getting 30, 40, 50, 60% a year, you're still maintaining a possibility of 1,000x.
Yep.
The underlying asset could still 1,000x. But even if it doesn't, you did pretty well. So
Yeah.
that's, like that's the opportunity. And and as far as I can tell, it's very unique to DeFi.
And here early. Someone says, thank you guys so much. I'm all about patience and lowering emotional volatility. I also have very high risk tolerance. I'm super excited to be here early. So yeah, this really is just value, guys. There's no benefit. I mean, we're trying to equip you guys the best we possibly can based off each person's expertise as well. So cool. I know there's not a ton more time, Brandon. So let's continue to dive through these questions and then by the way, guys, these calls can be, we're going to try and do these every week. So this is not like a once in a long time. This is like, we want to help you guys get good at this and understand the game in a way that makes you a winner over time. Because like a lot of people say, Brandon, and I hear this all the time, like whether there's euphoria, whether there's a bull market, whether people are crushing it or not, very few people get out of crypto in huge profits. Very few.
Right.
Even if they were up 100K at one point, because people have that mentality, well, it could 50x from here. Yeah, but you already 6x'd, and getting a 6x in real world is nearly impossible. So take it. You know what I mean?
Right. Yeah. And just to sort of address impermanent loss, because I want to get to some of these other questions too. The impermanent loss calculation is only in hindsight. So of course we can look backwards and go, oh, shoot, I could have made more if only I had done something differently. But we don't know that we would have made that different decision when we had the decision to make in the present time. So yes, impermanent loss is a reality, but I promise you, you will drive yourself insane, always looking backwards and always thinking, oh, shoot, I made a 6x. I could have gotten a 7x if. Because you can drive yourself crazy doing that even with moonshots and go, shoot, I got a 10x. I could have gotten a 15x if I had waited longer. Even though if you had waited longer, it might have dumped back down to a 4x and you just don't know. So yes, impermanent loss is real, but in my opinion, you're better off taking the long-term risk mitigated approach, accepting the fact that sure, you might be not chasing the highest maximum possible return, but you don't need to in crypto because somewhere in that nice, comfortable middle range in crypto is still these insanely amazing returns. So we can just appreciate the fact that we have this opportunity to make a lot of money without chasing more and more and more. Okay, so there's a question about trying to find on Crystal what the yield tokens are. Pretty sure it's the paired tokens, but cannot find that. And yes is the answer. It is the paired tokens, but this is also an important distinction in V2 versus V3. So for example, let's say I do a V2 pair. I do guard BUSD. I do a V2 pair on NightSwap. I am going to earn trading fees, but the trading fees, though they are paid out in guard and BUSD, they will get automatically compounded and added back to the value of my LP pair. Okay. So if I start a pair on January 1st and the price ticker just goes up and down and 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 down. And then by August 1st, it's at the same price as it was. I will still have a larger, my LP pair will be worth more because I have had all those trading fees compounded over the course of that time. V2 is a little tricky because you don't see that happening. There's not like a visual feedback loop for you. So a lot of people get scared away by it because it's like, well, I can't, where are my trading fees? They are there and they're being automatically compounded and add back into the value of your LP. Then on specifically NightSwap, there are often additional what we call farms where you can stake the LP and earn additional rewards, which will typically be paid out in the form of the native DEX token. So it would be Night on NightSwap or Cake on PancakeSwap. Those are additional rewards on top of the trading fees. So for example, on PancakeSwap, the UI shows when you hover over the little calculator button, the UI tells you, hey, the total APR prediction is this. Here's the breakdown, X% in fees, X% in cake rewards. So that's just something to be aware of. If you do V2 liquidity, you won't necessarily see those trading fees getting added up, but they are there. They're just accumulating on their own. Versus V3, if you use, for example, a platform like Crystal, you'll see it'll break it down for you. It'll say, hey, fees generated is X. It's here it is in guard and USDT. Here's how much guard, how much USDT that you have. You can harvest that, just that, and leave your LP in, or you can compound it back into the original pair. It gives you the option of how you want to distribute those that trading fee income. All right, patience, high risk tolerance, permanent loss. I thought permanent loss was when the value of ate up the paired stable. It's not brilliant. I thought impermanent loss was when the value of your original tokens dropped and ate up the paired stable. I might be misunderstanding your question. That's not really what it is. I'll give you the quick definition. Impermanent loss is saying guard USDT. Let's say I have $20,000 and I do a guard USDT pair. And guard is only worth $1 at the time. And then later guard shoots up to $20. Impermanent loss is saying if you had just had unpaired guard at $1, left it to exactly $20 and then sold it, you would have made a percentage more than if you had paired it because half the pair is a stable coin.
Yeah.
But it doesn't account for the trading fee income that is generated by you being a liquidity provider.
Nor does it account, just to throw it out there, for the hedge, meaning if guard went down, you would lose less. So it's kind of a wash from a risk-adjusted perspective.
Exactly.
Yeah. So that's the price. It's almost like putting a collar on an option or something where it's like you do limit some of the upside, but you also limit the downside.
Yeah. Yeah. And that's a critical distinction because like I said, impermanent loss, the calculation only actually works in hindsight after the thing has happened. And you can no matter what the outcome is, you can always say in hindsight, ugh, I could have gotten a little more but that doesn't account for you're making the decision in the present moment and you're mitigating the possibility of multiple outcomes in the future.
And once again, guys, if you're overwhelmed or this seems a little complex, everything's complex till it isn't. And if you're feeling a little bit of overwhelm, you're sharpening your intellect as you continue to learn more and add this to your repertoire of knowledge. So understand that. And like Nick says, the purpose of getting smarter, the purpose of intelligence is to get more of what you want. So let this help you get more of what you want, which in my experience as an entrepreneur, surveying a lot of people, in my experience, what most people want is freedom. That's it. Everything they're doing is so they can do what the hell they want, whenever they want, be protected, have choices, and just be free. And they do the same thing they're doing now because they love what they do, right? So, Brandon, we'll end it at that for now. I hope you guys got some value. We got most of your questions answered. I don't think there was only a couple people that got off. Everyone's like locked in and stayed focused. So people want more of this information. People want more of these calls. So let's just continue doing these. Ideally, every week. And if the questions slow down, maybe every week and a half, every 2 weeks, and we'll go from there. But we have a lot of exciting things coming, guys, some guest speakers. I'm trying to get into a very good well-known project at a low evaluation for you guys. That's going to be hard because no one can get in, but I'm working on it. So we're working on more stuff for you guys to give you guys an edge. So stay tuned, stay locked in, make sure you guys are continuously learning and continuously betting on yourself. And I know it's been an interesting, to say the least, last 6 months to a year. And then when you think about what's happening in the world right now with the election coming up, you just got to be sharp. You got to be around sharp people. You got to have a nice, strong, intelligent advisory board. And you just have to make sure you're playing chess, because some people are playing chess, some people are playing checkers, and some people aren't even in the game. And the ones that are in the game, I feel very, very, very bad for. Genuinely feel bad with how rough things are going to get. But if you're playing chess, you can stay ahead of it. I want to be around people like Brandon and Nick when things go down, because they're playing chess. So stay locked in. I appreciate you guys. Thank you, Brandon. Thank you, Nick. And we'll do a lot more of these.
Looking forward to it.
Yep. Have a great rest of your day, guys.